Hey, welcome back to Compounding Quietly. More leverage doesn't mean more opportunity. Most investors thinking about TQQQ have never fully pictured the downside. Not the percentage, but the experience of sitting inside it. Let's get into it. When markets are rising, leverage feels like a natural reward for conviction. Your position grows faster than you expected. The account balance moves in a way that feels like real-time confirmation. And for stretches of time, sometimes extended stretches, that feeling reflects something real. But leverage doesn't have a preference for direction. It reflects the market with equal precision on the way up and on the way down. The version that feels exciting in a bull market is the exact same mechanism that becomes very hard to hold in a sustained correction. Every market cycle, investors rediscover this, not because they didn't understand the concept before they invested, but because there is a meaningful difference between knowing that 3x leverage amplifies your losses and actually sitting inside a position that is down 65 or 70% with no clear signal about when it turns. That is the point where the comparison between QQQ, QLD, and TQQQ stops being a theoretical exercise. It becomes a very personal question about what you can actually hold. Most investors who held TQQQ entered during a favorable period. The leverage was working, the direction was cooperating, and the risk felt manageable because the portfolio was growing. But a leveraged ETF in a deep drawdown requires you to hold through something that looks nothing like what you experienced on the way in. The numbers are different. The emotional weight is different. The decision you are making in real time is completely different from the one you made when you were buying. The right judgment is not about which of these three performs best in a 5-year bull market. All three will deliver when conditions are favorable. The right judgment is about what each one costs you when conditions stop being favorable and whether you are genuinely built to stay through that. Let's walk through the structure of each. QQQ tracks the NASDAQ 100 at 1x. No leverage, no daily rebalancing mechanics, just direct index exposure. When the index drops 10%, QQQ drops approximately 10%. When the index recovers 10%, you are roughly back to where you were. The relationship between the product and its underlying index stays consistent over time. That consistency has real value, especially when a correction runs longer than you originally expected, and the only thing you are relying on is the stability of that relationship. QLD targets 2x the daily return of the same index. Every trading day, it resets its leverage to maintain that 2x target. This is where the mechanics begin to diverge from what most investors naturally assume. On a day the index falls 10%, QLD falls approximately 20%. But over a multi-week or multi-month period of volatility, the actual cumulative return will not be exactly 2x the index return. In most conditions, it will be less. The reason is something called volatility decay, also referred to as beta decay. It is a mathematical cost that accumulates when daily leverage resets in a market moving in both directions without a sustained trend. Here is a simple illustration. If the index falls 10% one day and rises 10% the next, it does not return to even. It finishes down approximately 1%. A 2x product that lost 20% and then gained 20% finishes down approximately 4%. That gap looks small in a single week, but it accumulates across months of choppy, sideways market conditions. The more volatile and trendless the environment, the wider that gap becomes. For investors planning to hold QLD through years of mixed conditions, this is a cost they will absorb, whether they account for it up front or not. TQQQ operates at 3x daily leverage. The same rebalancing mechanic applies, but with 3 times the sensitivity. A 10% single-day decline in the NASDAQ 100 produces approximately a 30% decline in TQQQ, and the volatility decay effect is proportionally larger. In a non-trending choppy market, even without a directional decline, TQQQ can lose meaningful ground from daily rebalancing friction alone. Now let's put a concrete scenario on the table. Imagine the NASDAQ 100 experiences a sustained decline of 33%. That is within the range of corrections that growth-oriented indexes have seen in previous cycles. Not an outlier, a realistic baseline worth modeling. QQQ would fall approximately 33% alongside the index. A recovery of roughly 50% from the bottom would return it to its previous level. A significant requirement, but one that previous multi-year cycles have delivered. QLD at 2x daily leverage would likely fall somewhere between 55 and 65% in the same scenario. The exact number depends on how volatile the path down was. At a 60% drawdown, QLD needs to more than double from the bottom just to return to even. TQQQ at 3x daily leverage could fall 75 to 85% or more in that same scenario. At an 80% drawdown, TQQQ needs to increase 5 times in value from the bottom just to return to where you started. That is not an edge case. It is a mathematically grounded outcome. For a correction that falls well within historical precedent and recovering 5 times from the bottom requires both a sustained directional move and a timeline that no one can predict in advance. This brings us back to the original question. How much riskier is TQQQ compared to QLD and QQQ? The honest answer is that it is not proportionally riskier by a simple multiple. It is asymmetrically riskier. Losses accumulate faster than gains restore them. Volatility decay accelerates during the conditions that are already hardest to sit through. And that kind of drawdown carries a psychological weight that no return chart can fully prepare you for. None of this is an argument that these products are the wrong choice, but each one requires a different version of you to hold it through a full cycle. QQQ asks you to stay patient through normal market cycles. QLD asks you to stay patient through drawdowns, significantly deeper than the underlying index. TQQQ asks you to stay patient through periods where your account looks like it may not recover, even when your conviction in the underlying thesis is still intact. That is a real and specific psychological requirement. Not everyone can meet it. The product does not reveal that gap before you invest. It reveals it in real time, during the drawdown itself. The gap between what you believe in concept and what you can hold in practice is the most underrated risk in leveraged investing. And it is worth knowing which version of yourself you are before that moment arrives, not after. The question is not which one compounds fastest under ideal conditions. All three perform well in a sustained uptrend. The question is which one you can genuinely hold through the conditions that are not ideal. Because those conditions are not optional. They arrive without a schedule. They tend to last longer than your original estimate. And the moment when staying is most important is usually the moment when staying feels hardest. If the version of yourself that holds through a 30% drawdown is calm and grounded, but the version that holds through a 70% drawdown is no longer recognizable, that answer is already there. Leverage does not reward the investor with the strongest conviction alone. It rewards the investor whose ability to stay genuinely matches the product they chose to hold. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.